Welcome, guys. I'm here with Karl Domm. This is Chat with Traders, and we're here with you on a Friday evening. I know it's Friday afternoon in where Karl is, and we're here to discuss with you options trading and ways that you can improve and try to beat the market and improve your returns in this very treacherous market. So, Karl, can you please introduce yourself briefly so that everyone can get to know you a little bit?
Yeah, sure. I'll just kind of try to give a brief kind of explanation of where I came from. I came from all retail. I didn't come from Wall Street in any way, shape, or form. I have owned several businesses. One that I'm helping my father manage right now is in the multi-millions. Ever since I was 19, I was always looking for ways to, how can I make money the easiest way possible with the least amount of effort? And running all these businesses that I've ran, I've realized that it's time is the issue. Like, I can make money, but like, do I have any time with that money? So then at that point, I focused in on how can I invest, because that's more of a passive situation. And I didn't do too well. I started in the mid 1990s online, didn't do too well. I did okay. Not too well, actually. And then by the time I get to 2008, I actually blew out my account for the sixth time. And I blew it out to a level to where it was unrecoverable. And so at that point, I just kind of started studying more because I was real stubborn and thought that I could just learn everything on my own. But after that last blowout in 2008, I realized I need to learn from others. And so I took a deep dive into online trading and online courses. And I've been through easily over 30 courses, probably closer to 50. Basically what I've found is that they've always tried to teach me something, and I've always tried to learn what they're teaching me. But I would never fully allocate capital or anything. I'd always back test it and realize, this doesn't work. So I did that for quite a while, all the way up until 2017. At that point, I found a really good course. And I was able to take my trading to that next level. And at that point, from 2017 on, was kind of where I've been basically profitable. It took me around 25 years. I've been doing this for close to 30 years now. And from that point, I started my own YouTube channel. There was another thing, after taking all those courses, I kind of figured out some of these guys are just kind of not being realistic. They're kind of full of it. And I wanted to, prove that. I got tired of seeing these guys out there touting that they were making all these returns and doing all these fantastic things. So I decided to take some of their courses and report on what I found. And easily 9 out of 10 are just not good courses. There's nothing there to learn. And in fact, they pretty much are just offshoots of Tasty Trade. And in Tasty Trade, you can get a lot of stuff over there for free. So I always I try to send people that way, and that's kind of my background. So I just wanted to get that out. So if you wanted to go into some questions.
Sure. As far as, I'll give my background very briefly. So my name is David Jaffee, and I used to work in investment banking, which actually does not have much to do with trading, because the sales and trading is a totally different, it's a different desk. Now, that being said, though, we do deal with the stock market in like floating out equities, whether it's follow-on equity offerings or initial public offerings or things of that nature. But when you're an investment banker, you're primarily acting as a conduit and as a deal maker between people who want money and those who are looking for capital. So, you're looking for like strategic M&A, mergers and acquisitions, or you're looking for like debt or equity raises or things of that nature. I did that at multiple investment banks. I worked at Morgan Stanley. I also worked at CIBC World Markets, and I also worked at an M&A boutique called Pesky Prunier. And then I pretty much on the side was doing some retail trading, and I started trading options around 2010, coming up with like my own strategy. And I started YouTube, I think, around like 2017 as well. And that's pretty much where we stand. a few things that Karl mentioned, which I think were incredibly interesting. So Karl, you mentioned that you had about like 6 failures, and then you were also trading for about 30 years. And you also mentioned that you took about like 30 courses. Now, I definitely believe that the courses that you took, which are kind of derivatives of Tasty Trade, in my opinion, those were probably more value add than the courses that you took, which encourage people to like day trade or, do things like the Tim Sykes way of trading, like trading penny stocks. So those, in my opinion, are there's really like no strategy involved with like, or people who are like pumping and dumping the stock to their followers, which happens a lot on YouTube. You take like low penny float stocks, and then they tell they buy them before, and then they tell their people that that they bought them at a later time, and then they just sell into their followers who are buying. But what do you, because it took you like 30 years of trading and you had multiple failures, what do you say to the people? I guess this is a two-part question. What do you say to the people who are following people on YouTube who are like 23 years old and who tell you that they can turn like $5,000 into like 5 million? And additionally, what do you tell people who join or who want to start trading options and who expect like instantaneous, or who expect like instantaneous success? Like, what are your thoughts about that?
Well, my thoughts are, my journey where I started watching CNBC and started saying, oh, these talking heads guys say I should go long. So I went long, and then I would go short or whatever they would say, but that never made any money. Then I realized, hey, there's these guys with these charts that could teach me how to read a chart, and I can go long or short based on a chart. And I did that for a while, didn't make any money. Then I realized, whoa, I could use options and I could leverage myself and buy options, but those were low probability. So all these things that I'm talking about, like doing the charts or learning about options, just because I took the time to learn about options and I invested my time into that, doesn't mean that there's an edge. So people think, oh, I'm going to invest into options, I'm going to learn how to buy options, and nobody else knows this stuff. And because nobody else is really willing to do this, I'm going to have an edge. Well, that's not true. That's not true at all. But once you start selling premium, then there is an edge in there, but you got to be careful with that edge. You got to work that edge properly. So people that I think they can turn 5,000 into a million, they're probably in one of these four areas. They're listening to CNBC, or they're following some guy about charts, or they're learning about options, and they're believing these kinds of things. And I just believe they don't have the experience yet of actually trying to do it. So go ahead and try and do it. That's the way I was. I wouldn't have listened to anybody else. I would have just done it because I felt like I could do that too. When I was younger, that's what I thought. And that's how I blew up my account 6 times, because I believed, hey, I have an edge. I can figure this stuff out. But it takes more than that. I can just say, if you don't like Tasty Trade, we talk about that because they have very good education. And the reason why they have good education is because of the way that their business model is. They're a broker, so they want to tell you everything they can because they're not hiding anything behind a paywall. Because they don't need to make money. So they want you to trade.
Because it's a funnel into Tastyworks. And I'm not,
and look, there's nothing wrong with that.
Right, exactly. Like we're not being critical of Tasty Trade. I just think that during the times when the actual volatility is going to be significantly more than the expected volatility, I believe that during those times, most Tasty traders are going to end up blowing up their account because they're not properly hedged. Now, that does not mean that Tasty Trade is a scam or anything like that. I definitely don't believe that. I think that Tasty Trade has done a tremendous amount of good for the community.
Absolutely. And the point I was going to make was, I always kind of forget as I keep talking, so I have to remember. If you understand the Tasty Trade methodology, okay, so you're at that level, I call it level 4. That is a good level to be at, but it's not a level yet to be profitable yet. So if you think you're profitable trading options and you don't understand fully what's going on Tasty Trade, but you think you're going to be profitable, you're not. Because even if
Right.
you understand fully on Tasty Trade, you're still not going to be profitable. You're still not ready. You still haven't reached a level where you're going to be profitable yet.
But I do think it's fair to say that if you understand everything that Tasty Trade is saying, then you might have an inherent understanding of how options work. And then it's going to be extremely easy for you to make modifications to the strategy where you can be consistently profitable.
Exactly. So that's a good way to gauge it, though. If you are
Right.
you at that, I call it level 4. Are you at that level 4? Can you understand level 4? Are you in there? You get it? Because now you're ready for level 5. If you don't really understand what's going on in Tasty Trade, you're not at that level. You're not ready to take that next step and get to that next level where you will be profitable, where there are profitable trade structures and trade plans beyond Tasty Trade. But so the point of what do I tell people that think that they're going to turn 5,000 into 10 million or whatever? Well, first of all, you're not really going to do it by picking stocks and being directional. I mean, that's just kind of been proven on my channel over and over again. So now you're at a level of, well, what's your level of options trading? Because that's where there's an edge. And if you're not fully into understanding what Tasty Trade's doing, you're not going to turn 5,000 into anything. You're going to lose money.
I don't think any legitimate traders or anyone who actually trades options or who has done it for more than like a year or two believes that it's possible to turn 5,000 into 5 million using like any legitimate trading strategy, you know, whether it's because the difference between like the way that you trade and what Tasty trade, the way, you know, it's like hedging and then using like using different levels and second order Greeks in order to get yourself a consistent edge, which Tasty Trade is not using. But Tasty Trade is not really telling people. I mean, I think Tony said that you can earn like 1% a month, or even if it's 1% a month over, but like what the S&P. But he didn't even say that. He said like 1% a month. So any legitimate trading instructor is not going to promise you like or indicate that it's possible for you to consistently make like 200% a year or even like 100% a year.
Even like 60% a year.
Yeah,
even
exactly.
I mean, you're pushing it, you know. I wouldn't put my money into something that, unless there's something out there I don't know about, but I've been doing this for almost 30 years, so there probably isn't. I mean, I don't think there is.
Mm-hmm.
If there is, let me know. Go ahead and put in the comment section so I can look at it. But yeah, I mean, I guess the point I'm making is, don't think you really even know anything until you're at least at that level of the Tasty Trade level where you understand exactly what's going on with them.
I do though think that for some of the watchers and some of the viewers who might be pretty young and who might be saying, well, you know, I've been day and I got a few of these messages where people will day trade and then they'll make like decent returns over like 3 or 4 months.
Mm-hmm.
I think that what happens is that they have a tendency, and young people in general have a tendency to be overconfident. I know that I definitely was when I was in like my early 20s. And life has a tendency of like beating you down based upon the experiences and the older that you get. So if you're younger and you're watching this, we're not necessarily saying that you're wrong, or we're not hoping that you fail or anything like that. What we are saying is that if your level of confidence right now from like day trading and you've been successful over the past like 3 or 4 months, let's say it's at like a 9, maybe you bring that back down to like a 6.5 or a 7, and you take some of the money that you've made and put it in your bank account, or maybe you even just start learning about less risky strategies. And I hope that you continue to make money, but you know, I from my experience, I don't think that retail day traders are consistently profitable over the long run. And I think a few studies have indicated that. Are there a few very successful retail traders? Yeah, of course. But the odds are against you.
No, I haven't found any, and I've been looking for some. A lot of people they claim that they are, but then when I ask them for more details in their statement and things like that, they don't want to give them to me, and they have some excuse, and that's fine. I'm still looking, you know.
I was being extremely nice. I have offered people like $1,000 to send me their last 3 months. But I also, at the same time, I don't want to like trample upon people's. I don't want to tell people that anything is impossible, right? Because when you take such an extreme viewpoint on things, people have a tendency to like tune you out,
Yeah, I
So
get it.
I don't. That's why I kind of have like modified. I don't want to say like, oh no, you're definitely going to lose money, because I hope that they don't, And I think that by having like a softer, by coming at things like softer, it actually encourages people to learn more, as opposed to taking a super hard line stance on something and then people just look at you as like more extreme.
Yeah,
Um,
I had a guy who was emailing me because he was successful for like a year and he really thought he had an edge and he was challenging me and everything. And I was, being cool with him. I wasn't, we weren't arguing or anything, but I said, okay, well, let's see how you do over the next couple months, 3 months, 6 months, a year. And, his edge went away. And he's like the only one that I kind of felt like, well, man, this guy did well for like a full year at day trading, but eventually he fell off. I don't have a problem with, if I believed I had an edge, I would go ahead and do it and see what happens. Maybe you do have an edge, but you got to put your money in it and you got to see what happens. And that's what I did. I mean, I blew up 6 times. I mean, I'm not afraid to go out and think that I have something and do it. So, I mean, that's a good sign, really, when I think about it, is somebody that's willing to fail, when someone's willing to put the risk out there and do it. That's better than somebody that doesn't do anything. So,
I agree 100%. So remember what Carl just said. If you try like day trading or any other methodology and you fail, especially if you're young, then that's not necessarily a bad thing. It's really now, obviously you would prefer to not have lost money, but it's not the worst thing. It teaches you about risk. It teaches you about other ways that you can be consistently profitable. So I don't think it's the worst thing in the world.
well, there's no way I could have gotten to where I am without failing. So you got to do it.
Early on in YouTube, we were both making videos about, like I made videos on like warrior trading, Raging Bull, Tim Sykes, etc. And I know both of us have stopped making videos, although I do have one video that I've actually made and I may or may not release it. But I've also noticed that you've stopped making those type of videos as well. Why did you stop making those type of videos?
The main reason is because I just seriously got bored. I'm just seeing the same thing over and over again. So for example, when we talk about Tasty Trade, every time it's an options guy, I can relate it back that he's doing something that he learned or that is similar to, or that kind of stem from Tasty Trade. So I'm like, okay, there's nothing unique going on here. It's boring to me. But and it's a little bit of a grind. But it's just easy to say, are you showing your P&L or not showing your P&L? Are you showing your trades, your account or not? Because if you're not, then what are you hiding? And if you're hiding something, then you're hiding a lot, So that was another reason, like, there's just kind of like I was seeing the same thing over and over again. And it just wasn't fun for me anymore. Now, I'm not saying I'm going to never do it again. I probably will do it again. But I just decided this year to change my model up, to give away something. I call it the safe wheel. And I do a live stream every Monday morning. And I trade a real account right in front of you with a system that I developed. And it's doing quite well. This year, it's up 22%. But it averages 10% a year on average based on backtest and everything. But I thought maybe if I give away something really good and I give it away for free, that it'll build my channel. But unfortunately, it hasn't built my channel as much as doing reviews about other traders. But, I'm trying to build my channel because it's fun. I love business. I love putting myself out there. And, I just changed up the model basically, mainly because I got tired of doing it. But I'm starting to get a little bit of the fever back. So you never know.
Yeah, I stopped primarily because I wanted to stop with like the negativity and things of that nature. And I just felt like waking up and having like 30 comments telling me that I'm stupid. Now most of the comments were fake, but because
Yeah.
whenever like supporters of these people, they have
Mhm.
like bots leaving fake comments on the videos, but having these people leave comments and then like arguing with people, I just really didn't like the negativity. And then also, I think that um, if these people really want to follow like people who are encouraging them to day trade, then I think it's going to be very difficult for myself or for anyone to really change their mind. I think that it's imperative for them to learn from experience. So yeah, the videos, they might help those people who are on the fence, but for those people who are hell bent and who are intent upon day trading and giving something a shot, I don't think that it really impacted or helped them at all. I think it just alienated them and made them more likely to want to like prove me wrong by like day trading or following the person that I was doing a video on.
And I
So yeah.
understand that aspect of things. I kind of look at it a little bit differently, where I feel like people are going to gain some experience through my reviews and kind of move through those, like I said, that tier 1, tier 2, tier 3, tier 4, move up the ladder. And some people need to experience taking the courses for themselves and realizing, yeah, this doesn't really work for me. Or
Mhm.
maybe they can watch my review and maybe move through that ladder a little faster, because the people that I feel like are attracted to me or my channel are people that have experienced other instructors and have failed with other instructors, and they're like, wait a minute, this guy shows his P&L, so there's nothing fake going on here, and they're tired of the fake stuff. And so it's people with more experienced students, I should call them, I guess, that tend to kind of make their way towards me. So I kind of look at it like that, and I'm hoping to help people move up that ladder faster. Maybe hopefully that's what my reviews do. But
Mhm.
yeah, we do get a lot of the negative comment, the negative feedback, and sometimes these guys that we review aren't necessarily the most, I don't know what the word is. I mean, I do know what the word is, but I really don't want to say it because I try to be as neutral and nice as I can be. But they have agendas, and their agendas are, they don't care about their students at all.
Mhm.
So I can just put it that way. And they're just out to make money. And if they get over on you, they're happy about getting over on you. That's their goal. Their goal isn't really to help people, or their goal isn't anything that they're saying to you. They basically, a lot of them just lie, and it's just unfortunate. And I'm willing to go out there and put myself out there and see if they're telling the truth or not. And I got kind of tired of it, but like I said, I might be doing that again.
Yeah, real quick before we move on to the options trading, I think one of the reasons, and let me know if this is consistent with you, I have noticed that my channel growth has significantly slowed since I stopped doing reviews, and that is one reason why I might do it again, but I don't know. I don't know. We'll see. It just seems like YouTube
Yeah.
rewards negativity or like those type of videos, unfortunately.
Yeah, it's like you're talking about somebody else and it's a little bit negative, or however you want to state it. And wow, people just eat that up, or YouTube, the algorithm eats it up. Because I feel like, man, if I'm showing somebody a free trading system with options called the Safe Wheel that makes money, I'm like, what's better than that? How is that better? How is that not better than a review of some guy who doesn't make money trading and I can prove it? Like, how I would rather learn something where I can make money. So for me, the algorithm isn't really picking up on that. And I guess that means people aren't really picking up on it, I guess, if the algorithm doesn't pick up on it. But yeah, my channel has slowed significantly since I stopped doing reviews, which was about 6 months ago now.
Mhm.
Yeah, I've definitely seen that.
So speaking about like buying options, I wanted to um and like trading options and things like that. So previously, I guess probably prior to like um 2022, I didn't necessarily think it was extremely important to buy options. Now, obviously, buying them as part of the spread, so therefore you have a defined risk trade, is definitely worthwhile. But now I believe, because we're currently experiencing the first downtrend and down market probably since like early 2009. Like I don't believe that we've had another down period that we've experienced in 2022 for like the first 6 months since early 2009. I definitely believe that it's extremely important to buy options, primarily because it's going to protect you against very large volatility spikes and times when the actual volatility is significantly more than the expected volatility. And remember, when you are selling options, as Karl said earlier, you do have a statistically significant edge. However, that edge erodes away during periods of high volatility, especially because if you're trading naked without protection, then there's going to be significant correlation risk amongst many of your underlyings and many of your trades, and you might be forced to close out the position for a large loss. And I experienced this myself with PayPal, where I experienced probably the largest loss that I've experienced maybe ever. Like PayPal was pretty bad because I went short the position and I was short a few puts. Thankfully, I traded it small enough, but it was still pretty significant. I was short a few positions at 200, and then I added a few more, and that definitely was very eye-opening. And Karl, what are your thoughts about everything that I just said regarding like buying options to make sure that you mitigate the tail risk and things of that nature?
Well, I don't know if you've read my book, or you've probably heard me mention this many times. If you're a premium seller, there's 4 different market types that you have to deal with. You've got the bull, you've got the sideways, you've got the grind down, and you've got the crash. Now, everybody knows what a bull market is and a sideways market, okay? But what's the difference between a grind down and a crash? So the way I define it is, if you were to go about 45 days out, you were to buy a SPX put that's worth about $1, or if you were to sell one that's worth about $1. If you go through a grind down period, that SPX that $1 might turn into $8 or $10 or $12, $15 maybe. If there's a crash, that $1 put will turn into $50 or even up to $90. So that's how I define with a grind down versus a crash. So if you are long those little teenies, that's what they call them, right? The little $1 or somewhere down there, deep in there, that's going to protect your portfolio in a crash. It won't protect it necessarily in a grind down. But grind downs are easier to protect yourself against. They're easier to diversify against. Crashes are very difficult to diversify against for a lot of people. And one of the things that most portfolios are not long is when there's a crash, everything becomes correlated. Gold, you name it. It doesn't matter what it is. It's the S&P, whether it's tech, they all become correlated and they all lose money in a crash. They all go down together. They become a correlation of one. There's only one asset that you can buy in a crash that can protect your portfolio, and that's volatility. So you want to be long volatility. And the way to get long volatility, the way I do it is I buy those little teenies that turn from $1 turn into $90. So that's going to protect your portfolio if you're able to buy those teenies and you're able to finance that. So that kind of brings a little drag on your portfolio. So there's got to be ways where you can take away the drag and also own the volatility protection, the long vol. And you want to be long vol, again, without it costing you more. And you want to be proactively long vol. You don't want to try to get long vol after the crash started or after the crash occurred.
So they're extremely expensive, because then VIX is trading at 30, 35, and you're spending 3 times more. Instead of $1, you're already spending $4.
Yeah, or you're spending $15 thinking, oh, this is going to protect me. And then it's not one of those crash scenarios. It's just one of those scenarios where the market recovers and then you got whipsawed. So you need to be long vol proactively. And one of the ways that I trade is I'm proactively long vol, but I'm reactively behind the market. In other words, I'm reactively directional. In other words, the market can go either way, go up, down, sideways, and I can react to it. I don't have to be right because I use second order Greeks. If you're only typically dealing with first order Greeks, you typically have some gamma. And the way I look at it, if you look at a risk graph, if you understand how a risk graph works, the gamma is the curvature of the T+0 line. So you want that to be flat. And if it has a curve to it, like if you're doing spreads or the first order Greek type stuff or the tasty trade stuff, I should say, like that kind of stuff, you're not flat gamma. You might be flat delta, but you're still not flat gamma. And any kind of move up or down can hurt you. So the goal, though, is when you're selling premium, is you want to be able to collect theta. So you want to be able to collect on the depreciation,
Right.
without being directional. So the goal is to not be directional, but collect theta at the same time. And so that's kind of the challenge. And I see a lot of, that's where I, say where the level 4 ends and the level 5 trading begins, is that you're proactively hedged and you're collecting that theta without that directional risk. I don't know how we got all the way into that, but that's
the way that you're going long volatility is you're buying options on SPX, right?
Right.
And one of the added benefits of using SPX, especially when you're using portfolio margin, is that it's a 1256 contract. So you're able to realize some of the tax advantage benefits relative to trading other underlines as well. Correct.
So the way that I trade, I'm usually out of any position that I put on within 60 days. So I'm actually, converting things into cash quite a bit. It's all short-term trades. But when you use options on SPX, you're able to take advantage of the 1256, like you mentioned, and you can take 60% of what you make and you can put that into the long-term capital gain category and pay less on it. And then 40% you pay the short term. It's kind of the rich man's game. Another thing about SPX and using SPX as a hedge is that it's different than like the RUT or some of the other options, some of the other indexes, because that's where the big guys go when they want to hedge a portfolio. The big guys, what do? They'll go out and buy a 1 standard deviation puts in the SPX. They're not, they're not buying them in the RUT, and they're not buying them on Apple. They're buying them on SPX. So when I talked about a crash market affecting the SPX pricing of the options, this is the best way to go, the best place to be, because that's where a lot of people go to hedge, and they usually reactively hedge, which creates great profits for your proactive hedge, if that makes sense.
And so you're saying that this form of hedging protects against a crash market. Would you say that there was any time during the 2022 pullback? Now, I do believe that in 2020 in March, that was a crash where the market fell like 36% in 33 days. Would you characterize any of the trading activity that we've experienced during 2022 to be a crash, or would you consider this to be a grind down market?
It's been a grind down market from day one. I think the VIX maybe reached maybe 35 to 38 at the highest.
39, I believe.
39.
I think it hit around 30. I don't think it pierced 40, but
yeah. So, what happened with those $1 SPX puts, the 45 days out, they probably went to 15 or 20, $10 to $15 or maybe 20 at the most. Did they hit 50? Did they hit 90? No. So did my hedges ever get activated? No. So this is, to me, been a grind down market the whole way through. And a grind down market creates a special way to trade, in a special way that you need a certain structure, and you need to control charm. And the technique I use is that I have negative charm, and which is a second order Greek. And so if you have negative charm and you use it in a certain way, you can protect yourself against grind downs also. Now, not always does my trading system protect against grind downs. And the last 3 quarters of 2018, I think my deepest drawdown was around 9%, 9.5%. I know the market was down about 20, and I recovered very quickly. But I did have, what I would call a significant drawdown.
For what? The last 3 months of 2018?
Fourth quarter 2018.
Oh, yeah, that was bad, because October there was a big sell-off. In November there was a big move up, and then December 2018 there was a pretty sizable sell-off in December.
Yeah, it bottomed out on Christmas
December
Eve.
24th, I believe.
Yeah,
right?
the 24th. Yeah. But there was also a crash on August 24th, 2015.
Yeah,
there was a crash.
2000. Yeah.
August 24th, 2015.
February 2018.
And February 5th, 2018.
Yeah,
and then
yeah,
March
that
of
was a huge
2020.
volatility spike where the VIX shot up past 50. And actually, like the inverse options, like the UVXY, the
Yeah.
SVXY, they had to like recalculate how they were actually pricing because I think they like blew up
Yeah,
actually.
one of them got blown up and taken out of the market or whatever. Yeah,
Yeah,
I'm
and
not really an expert on those products or what that
yeah,
kind of stuff, but yeah, I remember it got taken out. But those particular crashes, my hedges activated and protected my portfolio. In fact, the system I have doesn't necessarily just protect the portfolio. I actually make money when there's a crash.
yeah. I think August 24th, 2015, like that. I think that was like a Friday or something, or maybe like, I think it kind of continued like on that Monday as
Yeah, I think it was
well.
the Monday because I remember on a Friday the market was down pretty significantly, and then the
Yeah,
weekend
yeah.
came over, and then bam.
Yeah, yeah. And then it kind of stabilized after that Monday. Um, yeah, and so how so your trading system or regarding like buying options, is it do you find that it's more difficult now because if you're buying those like dollar put options that allow you to like to go long volatility and they provide you with a hedge, and let's say those options are trading at a dollar when the VIX is trading at about like 15, but now with the VIX trading at about 30, how much more expensive are those?
Mm.
Are you finding those SPX options to be $2? Are they $4? Is it more difficult to
Mhm.
trade in a grind down market? What are your thoughts?
No, well, it's not an issue because it's all relative to what I'm selling against it. And it isn't, I don't, you, I only mentioned the $1 aspect just for people to understand how it works, but I trade based on what the delta is. So I move with the market. And so, no, I'm
So
not
when
having
volatility
any.
is higher, then it actually provides you with a greater safety net as well.
That's right, because I
Mhm.
can go further out. And
Yep.
also the type of trading that I do when volatility contracts, uh, uh, I have a position on, the volatility contracts, that position makes money. So the contraction is makes money for me.
Yep.
So no, haven't had any. I understand where you're coming from, but no, that's not an issue.
Okay. Great. So I know that what we just spoke about for many people might be a little bit, like we're gonna. The next question
Can you bring
is
it
going to
back a
be
little?
probably a little bit less technical, regarding like, recalling like dates and like the volatility expansion. Although one thing to add before, when I think in March 2020, VIX spiked up to about like 84. And remember, so you can look at VIX levels to indicate what your thoughts are with respect to whether we're in a crash. You can also look at something like VVXY, or rather VVIX. I like looking at VIX and also VVIX because when I see VVIX spike up tremendously, then that sort of indicates that there's a large degree of panic in the market. And panic in the market would mean like when VIX is trading, pretty much like over 50 or like potentially, I would say like over 50, over
Yeah,
55, something like that.
45 typically.
Yeah.
Yeah.
But right now, even though 2022 has been like a large grind down market, remember that VIX it hasn't even pierced 40 yet. So we haven't hit that panic. That panic has not set in, even though the market many stocks have sold off like 30 or 40%.
Yep.
What are your thoughts regarding mistakes that many options traders make?
What do I think about it? Well, I think the mistakes come all the way back to the beginning, which is uh, they're basically directional. I mean, if you have to trade directionally, I couldn't do it. I couldn't pick the right direction. So if you're using options, typically what I see is people using options, but they're still being directional with their options. And for me, I wouldn't be able to, I don't feel like I can pick the right direction and manage money around that and be consistent and make money. That's my thought process after 28 years of trading and trying to figure out whether I should be able to pick a direction or not, or can I pick a direction? And then how do I manage my money around that? And then can I make money? Well, okay, now I can use options, but I'm still doing the same thing. I'm still being directional when I'm using first order Greeks with my options trading. So that's kind of the way I think of it.
If the market has a tendency, the S&P, if that has a tendency just to go up, like 8% or 10% a year on average, then why would it be bad for someone to either just simply go long SPY or sell puts on SPY that are, let's say, like one standard deviation out, and then maybe roll that position once and then just simply take ownership of it, and figure that if you're able to take ownership of the index for 15 or 20% below where it was trading just a few months ago, and if the market historically returns 8 to 10, and recently during 2010 onwards it was returning about 15% a year, how from your perspective is that a negative thing to go directionally long an index that over the past close to 100 years has returned what, like 8 to 10% a year?
Well, basically what you're saying is buy the dip, right? You can kind of correlate that to buying the dip, and that's worked since March of 2009, and it didn't work from the year 2000 all the way up to the year 2013. It hasn't worked for Japan since 1989 until now.
Yeah, the Japan, right? That is.
So
yeah,
that's a philosophy that works until it doesn't. And I could be wrong. It could work for the next 50 years, but I feel like I have a better way. And that's why I don't want to say I criticize it. Maybe I do criticize it, but that's why I am against that philosophy, only because I feel like I have a better way of doing it.
Understood. I'm just playing devil's advocate here. I think for me, like, if you go back until the stock market has been created, or effectively, let's say back in, even before the Great Depression, I think historically the markets returned anywhere from, let's say, even on the low end, like 8% a year. Now, I don't.
After inflation adjusted, is that what it is? About 7, maybe? It's probably right.
So from that perspective, if you were to sell options and not trade too big, where you could actually take assignment of it, and take assignment at perhaps like a 20% discount to where it was traded previously, because I believe that the market trades in cycles. I mean, very similar to what you said about how sometimes you're in an up market, a sideways market, a crash market, and then a grind down market. If you're able to improve your basis, I think that, I don't necessarily think that that's the worst thing to do. However, if you have a better strategy than that, then then it's better than that. But I just, playing like a little devil's advocate, that historically, like looking back at the last like 80 or 90 years.
Well, yeah, I mean, compared to all these other, even like a first order Greek option strategy, that's probably better, right? If you're in for the long haul, it depends on your time horizon, but there's nothing wrong with, buying and holding forever kind of thing. I don't do that with my money, but it's not a bad thing, and it compares really well to a lot of even option strategies that are out there that, yeah, it can do even better than those. So I can't say, if you look at it as a strategy, it ranks high. Definitely. I mean, I can't say that it's a low ranking thing, but I also don't know, since the late 80s up until 2022, if we want to get into directional kind of things, the Fed's been lowering interest rates all that time and supplying liquidity for the market. And now all of a sudden we have this inflation we haven't seen since 1980. And now what's the Fed going to do? They're going to increase interest rates. And how is that going to be? Is the market going to be lower in 10 years than it is today?
We don't know.
It's possible. I mean, before it kind of like didn't seem even possible, but now it's like, wait a minute, with this overall, the Fed puts not there kind of thing, this overall rising interest rates that hurts the economy in every single way, it hurts the stock market, it hurts the companies, all that. I mean, this could be the next downturn for 10 years. I don't know. If I knew for sure that the market's just going to continue to go up and up, yeah, that's a great that's a good deal. That's probably like way up there as far as strategies that you're talking about.
Yeah, I
And
mean, just thinking, I feel like considering that something like Amazon, I think its 52-week high pre-split was like 37.73 or like something like that. And then pre-split, it traded all the way down to like 2025. So that would pretty much be like $100 and like change. Um, it is like a little tempting to if you have a relatively large portfolio, like let's say like $1 million or 500,000, to potentially like buy a few shares, like buy like 50 or 100 shares of Amazon and just stash it away and don't look at it. If you believe that by Amazon selling off like 40%, then it would provide you some potential large upside in the future. Now I wouldn't do that's like a 50-50 bet. So the odds are not necessarily in your favor. But I think that it's okay for people to diversify their portfolio and use like some combination of long equity with options in order to try to juice their returns.
a lot of people do that, and a lot of people that I respect that are traders, they do that because they can trade with portfolio margin. They can buy stocks
And
and
then they can
use
leverage off that.
yeah, they
Right.
can use what 85% of the money, even though it's in a stock, they can take 85 for that
Right.
and use it to buy and trade options with it, so they can kind of get double dipped.
Right.
They can
The
double dip.
PM,
I don't do that, but
the
most of the people that I trade that I respect do that, and I just don't do it. That's just
I
me.
think that's a great point, and that's something that in the conversation with David's son, he also brought up. So one of the amazing advantages of using portfolio margin relative to, and when compared to regulation T, when you're using Reg T, you're actually paying margin interest when you're selling options. However, when you're using PM, you're effectively getting free leverage,
Yeah.
and you can actually go long stock or long an index, and then use that as leverage and effectively gain free leverage to then sell options off of that.
Yeah, or actually, it's as if you didn't even buy any stocks and you can still use that money. It's a double
And
dip.
you wouldn't, so for example, because like SPX is a future, like you would probably, if you were going to buy the stock, you would buy SPY and then leverage off of that. Because how would it work?
You can't buy SPX. It's not really
Right, because
yeah.
you would, if you bought it as a future, you would use span margin versus like, even though the portfolio margin is very similar, different brokerages, they use different calculations.
Yeah, but like bonds, if you buy bonds, I think you get like 95% of the money. So if you spend $100,000 on bonds, you get like $95,000 to where you can use that to trade options. So
For
that
PM, right?
yeah, just a double dip thing. I'm
Right.
not sure what the technical term is for it, but
Or when you're saying when you buy bonds, or are you referring using portfolio margin or using?
yeah, with portfolio margin,
Right.
yes. Or if you buy stock, they're not going to give you 95% of what you pay. Maybe they give you 80 or 85, and you can take $80,000 and you can trade options with it. And so now you're in essence trading with $180,000.
Right.
So, but and a lot of almost all of the people that I know that trade similar to what I do, they do that. I don't. I don't. I just don't feel comfortable. The market's down, comes down and hits circuit breakers in March of 2020, and I'm down 30% on my stock portfolio. I know, most people, I'm not like most people, and I just wouldn't be comfortable with that. That's just me.
Well, you could hedge the long equity with additional options, long options.
Yeah, but that would cause a drag on the portfolio. So if I'm
Yeah.
not selling premium
Right.
to
Exactly.
pay
Right.
for that,
Mm-hmm.
I don't think it's probably not worth it, because you only had, since 2015, which was 7 years ago, there's only 3 crashes. So really, it's that drag on the portfolio is going to kind of overcome what it was probably worth paying
Right.
for it, unless you're able to sell premium against your hedge and make money while your hedge is still there. That's what I do, but
Right.
I
Because
wouldn't. Yeah.
when you sell the options, there's theta capture, and then when you buy the options, you're paying theta. But when you're buying the stock, there's no theta component to the stock, nor is there a volatility component either. So if you bought the options to hedge the stock, then it would be expensive.
It's a drag on your portfolio. What are you going to spend? You got to decide. I'm going to spend 2%, 5%, 8% a year, whatever it is. And that's not a decision that I want to make. I'd rather just have the structure that I have on, make money with the hedge on,
As far as answering my own question, mistakes, I think that oftentimes people will trade too large, and then they'll be in a position, especially if they're trading naked, then they'll end up costing themselves a tremendous amount of money and lose money and effectively their account will be dwindled to a point where it's very difficult for them to recover. That's the biggest mistake that I see people making. I guess the secondary mistake for new traders is having unrealistic expectations. They think that they're going to be able to make 500% a year.
Double their money every 90 days.
Yeah.
That's what I did. I thought I could double my money every 90 days. I thought that I was smarter than I could find an edge, that I could figure this stuff out. I just put my mind to it and figure it out because I thought about it all day, every day, all day, and I still do. And it's 30 years, it's 28 years later. And the first, from the middle of the 1990s up till 2008, I blew out 6 times. Well, that's because I traded too large. And that's because I thought I knew something that I didn't know. So,
remember, just because you study, just because you think about it, just because you gain experience, that doesn't entitle you to make money, right? Like trading, it's basically it's very black and white. You either make money or you don't. I think that many people, when they go to college or they train for a job, they constantly improve, and then they feel like that things which were difficult in the past are now much easier. With trading, if you're studying or if you're spending all these hours learning how to read charts and looking at support and resistance and stochastics and all this other stuff, just because you're investing your time, it doesn't entitle you to make money. In fact, oftentimes what it does is it leads people to just simply be overconfident in their abilities.
I totally agree with you 100%. And like at a job, you're like the smartest guy, or a lot of stuff that people don't know, and you feel like, I'm smarter than the average guy. I know more than all these people around me. It's not like that with trading. You think you know more, but like I said, how do you gauge that? How would you know? Well, I'm just going to tell you, you understand Tasty Trade inside and out. Okay, now you're still not going to be profitable. Okay, so that'll give you a level of where I believe you need to be in order to get to that next level. So that's how you can gauge yourself right there.
I think Tom would take.
He wouldn't agree.
Be upset with what you just said, and saying that you're still not going to be profitable. Maybe invite Tom on your channel to have a chat. I'm very pro Tom. I think that he's probably worth a few $100 million. He's done wonders for option education, but I do think that Tasty Trade is incredible for beginning traders.
Yeah, intermediate.
Beginning. Yeah, exactly. It's not the end all be all. And to be honest, I think Tasty works. It's pretty expensive. I mean, they charge $1 per contract. I know that they max it out at 10, and then the fees that they pass through. Most of the brokers, especially if you have a larger account, I mean, I pay 10 cents a contract with E-Trade, and
maybe I should be looking into them. But I really like the platform of Thinkorswim so much, I'm willing to pay more in commissions.
Yeah, because you use the analysis tab, right?
Well, I do, but what I really like is the way they deal with margin requirements and things like that. Like Interactive Brokers, man, they don't. You know what a margin call means? It means that they're going to call you.
Close you out.
Interactive Brokers don't call you. They don't make a call. They change. They rip off half of your position. You come in the morning thinking you're Vega, you're gamma and delta neutral, thinking, oh, I might move $100 here, $100 there, and you're like at risk by tens of thousands of dollars because they pulled out something out of your particular trade, and now it's 100% directional and it's short, and the market goes up, and you lose. You're trying to make like $4,000 and you're down like $20,000 in one day because of the way they ripped your trade apart without even telling you about it. They don't even tell you. You got to go in there and see it. It's just awful.
I've heard a few people, especially some international students that I have with who use interactive brokers, because that and I guess in Canada you can use TD. Like TD is very big in Canada, but most of the international students that I have, they use interactive brokers, and they frequently complain about like poor customer service or getting closed out of trades early without even being able to adjust it.
Yeah, if you want to figure out what's going on, you can be on the phone for like 45 minutes before you can talk to somebody. They sent me an email asking me if I wanted to be an affiliate for them. And
me too. Like
a few weeks ago, because I just won't.
I think they actually like followed up with me. Like they sent me 2 emails.
Yeah,
like
they sent me 2 also. Yeah, and I'm just like, no.
Yeah. Oh man, and I can't even tell you the amount of emails that I get about like NFTs and softwares and stuff like that.
Oh really? I don't get a lot of those. I'm too old.
What are your thoughts regarding? So the next thing I had was thoughts about Tasty Trade, but I think that we beat that.
Well, I can tell you one more thing, one more interesting story about Tom. But you probably, if you saw my last video, I mentioned it. One of the things that is what I consider an advanced concept when it comes to trading is called weighted Vega, and you could put in weighted Vega and see a video on it. Ron Bertino did it. And you need to understand that concept in order to kind of understand second order Greeks and kind of get to that next level. And I emailed Tom Sosnoff a couple of years back about that. And he acted like he didn't know what it was, which Tom is pretty smart. And I think he understands the concept and would understand it if he took a little bit of time and looked into it, but it doesn't fit into his business model. So the fact that it doesn't fit in his business model, trade small, trade often. If it doesn't fit his model, he's not going there. So there is a little bit of a, playing into the business model thing going on over there at Tasty Trade. But again, I don't want to say too much bad about them, because if you want to learn about getting up to your level at intermediate level for free, rather than paying any of these other guys that do anything with options, pretty much almost like 98% of them are just Tasty Trade, but you got to pay for it.
I think that's one of my biggest criticisms of Tasty Trade is that trade often component, because especially since they're by far not the cheapest. In fact, on a per contract basis, they charge like 10 times more than what I pay at E-Trade. But I also think that it's a huge conflict of interest. And I also think that because many traders think that they have to be overactive and they feel that by making a trade, then they're entitled to make money. The reality is that making a bad trade is significantly worse for your portfolio than not trading at all. And I think that the more likely that you trade, the more trades that you make, some trades are going to be better than others. And it's usually those trades that you're kind of iffy about, that you're on the fence, that you shouldn't be making, that in my opinion, those are usually the ones that end up coming back to bite you in the butt and costing you a lot of money. So trading often, I think, is deleterious to many options traders.
Well, as far as the Tasty Trade methodology, it's kind of like you think you're a little mini market maker guy. I'm like a little market maker. And that's kind of the philosophy behind it. But I don't believe there's an edge when you're directional and you're using only first order Greeks. That's just my thought process and philosophy and what I've found over time. And that's all they think about is first order Greeks. So that's where I think they end up being directional, especially in a crash. Everything becomes directional with those positions that are on.
What are your thoughts regarding like realistic expectations regarding like annual returns when trading?
Well, with the average hedge fund makes about 5% a year. So these guys are supposed to be the smartest and the greatest traders in the world and all that kind of stuff, and they can't even outperform the S&P. If you can find somebody that outperform the S&P, you got a winner. Now, when I say outperform, I'm not talking about just having high returns. I'm talking about having better risk adjusted returns. In other words, my drawdowns are lower or the same, and I'm making more returns.
Mhm.
So that's the way I look at it. Your expectations, if you can outperform the S&P, that's a really good money manager, probably in the top 5% pretty easily to say that. So if you think you're going to make 15 or 20% a year, you might make 15 or 20%, or even 30 or 40% a year doing this, the tasty trade method or method similar to that. You are going to make that kind of money, but there's going to come a day of reckoning when the market crashes, and you're going to have a 50% or 60% drawdown. And when you have a 50% drawdown, what do you need to get back to even? You need a 100% return.
Yeah.
How long is that going to take?
Yep. What about why being delta neutral? Why do you think that is so important? I think you kind of touched upon that, because you can't tell the future, and you feel that the strategy and the trade structure that you have provides you with an edge. And because you're unable to tell the future, and with all the unknowns, the unknowns that we have regarding like the future of the marketplace and the Fed propping up the market, then it's better to not be reliant upon having positive delta. Did I answer the question well, or do you have anything more to add?
So I don't look at it as being, well, delta neutral is different than gamma neutral, right? So I really focus on being gamma neutral. So again, looking at that risk curve and that T+0 line, is it flat? Because even if you're delta neutral, that sucker could be curved.
Mm-hmm.
So a lot of times what you want to do though is, if you are gamma neutral, in order to remain gamma neutral, you adjust your deltas and you keep your deltas neutral under the gamma neutral flag. So that's how I use being delta neutral as far as delta neutral. So I don't know if that answered your question or not.
Yeah, it does. And that goes back to what you were saying about being profitable in the four market conditions.
Right. Some of the structures that I put on and use, they don't really have a lot of upside risk. I take away the upside risk, and I only worry about the downside risk. So the sideways and the up markets, I don't worry about at all. There's really nothing to even worry about. And then it's the grind downs and the crashes. Like crashes, I don't really worry about too much either. It's just the grind down markets that are challenging. This year, I did start a hedge fund, by the way. I thought I'd mention that.
I was going to ask you about that in like
but that particular trade structure and trading system that I use in 2022, it's been 6 months. I'm up about 12%. Now, after fees, I'm up about 9%. So you can kind of look at, I can still navigate through these grind down markets. It's just, I'm not going to say it's harder because I already have the trade plan in place, but it just, the trade structures and stuff that I use don't typically do as well in grind down markets, but they're doing fine this year.
I have 3 more questions, actually. One on options, one on real estate, and then one on hedge funds. What are your thoughts about buying calls? Or because I know that even someone who I do respect, like Adam from like In the Money, he sometimes recommends. I know that he recommended like buying a call on Boeing, which obviously is a losing trade. But what are your thoughts about what Tom Sosnoff says about like pot odds, where if you do feel that something is extremely undervalued or that something is oversold, buying a call. Now I know that that trade apparently is going to have a lower probability of profit, but very similar to hitting a 3-pointer in basketball, where it's a lower probability shot, but the upside potential of that trade could be significantly more. And even though you're paying for theta, what are your thoughts about buying calls?
Okay, well, I'd have to look at, are you buying calls on Apple? Like, let's get more specific about exactly what we're talking about. Because it depends on what it is. You can tell me anything that you're going to say right now. It doesn't matter. Let's just say it was Apple. Okay, well, let's buy, what are you going to buy? Certain deltas, whatever. And then what you need to do is just backtest that. See, well, how does that work over time? Do you actually have an edge? Or do you think that you can pick the direction and then only buy calls when you think the direction's going up and then back test that. So that's what I would do. And so far, whenever I buy calls in a direct, when I do anything in a directional manner, I lose money in back tests. So
There is actually, in my opinion, a structure that is probably better than simply buying naked calls outright. You could buy like an at the money, you can buy an at the money put and then sell it in the money put. And you know, that'll provide you, you'll be able to collect some premium on the short in the money, on the short in, rather on the short in the money put. And you
so
know,
it's like a
it'll
debit,
also help
a put debit spread.
yeah, it'll help deflect by selling that in the money put. It'll help
Oh,
deflect some of the money, some of the premium that you're paying for the at the money put
so it's
that
a
you're
put.
buying for protection.
So it's a
And
put
that'll
credit
mimic,
spread.
yeah, exactly. That'll mimic a, you know, a naked call, but it'll be cheaper because you're not going to pay as much premium. But on the negative of that structure is that if you have like a really big winner, you're going to have to roll up that short put, because whereas the call is uncapped, the short put is going to be capped essentially at the strike price that you sell it at.
Well, to me, all I hear is you're talking about a put credit spread, and then I would put that into a risk graph, and then I would see, okay, what does my T plus zero line look like? Is it directional? You know, is it like this or like this? And then, you know, basically bottom line is you're going to be directional with that strategy. And now you're back to the basics of, can you pick a direction? And yeah, you can make money with put credit spreads or call credit spreads because the probability of profit's higher, right? You're going to win, you know, 3 out of 4 trades kind of thing, because you're selling more premium than you're buying and you're selling out of the money. But, you know, then you get back to, you know, how much money are you making? Like I say, if you're making $50 every time, you make $50 3 times, it's $150. But when you lose $150. Well, you know, that's not really coming out ahead. So that's kind of the way I look at it. I just have that systematic way of thinking about it. And it's like, okay, well, let's run this scenario, you know, 50 times and let's see what happened. So that's the way I look at any kind of trade structure or any kind of options trade. I just throw it in a risk graph and I think, wow, that looks pretty good. I could make money. And then I back test it. And typically when it's got gamma that's not neutral, I really don't have a lot of interest in that structure, if that makes sense.
Yep, it does. Now you also have a lot of experience with real estate. Can you touch upon like your thoughts of real estate or like buying properties, and just touch upon like what your experience was? Like, did you have tenants, etc.?
Yeah, so I started investing in real estate when I was like 20 years old, and I bought my first house before I even had a place to live. I rented the house out. But I kind of wish I would have just held everything, and I ended up selling everything. So, you know, I have like one rental right now. I also have my California state broker's license, which I never really practiced. So I'm not like an expert on doing transactions or anything. But I've always been watching the real estate market. I've always been interested in it. I've owned probably 10 properties over my lifetime, 10 properties outside of the one that I lived in. That I, you know, and I've been waiting since 2017 for the market to to make a dip or come down or something, because, you know, I want to buy, but it's just kind of went up and up since then. And now with the interest rates coming up, you know, maybe the market will come down, because I remember in 2011 the market was just in trash. Nobody wanted anything. Everybody was out of the market. You couldn't get a loan unless you were like a perfect, you know, you had perfect credit. You couldn't even hardly buy anything, but everything was so cheap. So I'm kind of waiting for that to happen again and kind of get back into the market a little bit, mainly for my kids. I mean, they're 20, 22 and 27, and they don't own a piece of real estate. So I'm kind of like, you know, I get worried that they're never going to own anything. But that's kind of the way I'm thinking about it. Is I don't think of it as, do I want to put my money there as an investment to make a return? Because I feel like what I'm doing has better risk rewards, better return on my money
And more liquid.
More liquid. There's a lot of advantages to what I'm doing, and I feel very comfortable with what I'm doing, and I like what I'm doing. So as far as real estate for me, I'm not really looking at it as an investment vehicle from a heavy point of view, more of a, hey, I want my kids to have something, so maybe they have something that's inflation protected, like if they have a $2,000 payment now, and in 10 years from now, that's going to be like paying like $700 a month. So that kind of thing really is what worries me. And that's kind of what I look at from a real estate point of view, is kind of for my kids. And I've been waiting for the market to give me something. And I'm kind of waiting for the market to where, when nobody wants it, nobody wants to talk about it, oh, it just keeps going down, it's never going to go back up. I'm waiting for that time.
Wait, that was like 2010, 2011.
2011.
I think real estate's gonna come down about 20 to 25%, because just looking at, look, real estate is a relatively safe asset. Historically, it's gone up. I have no idea, like 5% a year, 4% a year.
I don't really know the numbers, but another thing is
3 to 5% a year. But what I do know is that in Miami and in many places in Arizona, Texas, also in Florida, real estate prices have gone up close to 100% in 4 years. And that's just not, I think that's incredibly risky. And I just don't think that that's sustainable. So, even if considering that it's gone up, even if it's gone up 70%, which it's gone up, in many places have gone up significantly more than that, having a pullback at 25%, in my opinion, is healthy. That's how markets work. They don't just go up all the time.
It's got to be healthy, because people can't afford to buy, because they're not making enough money to be able to afford the payment anymore because of the higher interest rates. So it's got to come down to meet some type of demand. And it just depends on the market. You know how every market is just local. And I believe that the ones that shot up the most, like Miami, they're the ones that are going to come down the most, right? And then you got Minneapolis or wherever. I don't know that market very well, but I just know that it probably didn't shoot up as much as Miami. And so it's probably not going to come down as much as Miami, but I do believe it'll probably come down a little bit. But you've got the highly volatile markets that are just going to come down heavy, and you've got the non-volatile markets that are going to kind of still be stable and probably not come down as much.
So I live in a community, and there's been like a large lead time and a large lag between when you actually sign the purchase agreement and when the house is actually delivered.
Mm-hmm. Yeah.
Oftentimes people are waiting like 2 years. So they put down 20%, and then they can actually only take out the mortgage, when during closing time.
Oh, wow.
So 2 years ago, mortgage rates were about 3.5%. Now mortgage rates are about 6.5%.
Yeah.
And if you throw in that the market is down about 30 to 35%, some stocks are down over 40%. And the crypto market has also collapsed, and crypto is trading for about a third of its value of where it was previously. I'm a little bit concerned that a lot of that many people who purchased a home with the intention of having a rising stock market and having a rising crypto market are not going to be able to meet their financial obligations, and they might actually end up losing their house. And I think that when that happens, that's when markets are going to come down. Now, I do think that Miami is going to be supported. I don't know if you heard, like Citadel from Chicago is moving down to Miami, and a lot of finance firms. But in general, I think that the real estate market has gotten a little bit too hot.
Yeah, I think a lot of those buyers, the only option they have is to forfeit the money that they put down to get out. So they're going to lose that 20% that they put down, or 5%, or whatever it was.
In the community,
and that might be their best option. Take that $20,000 or $30,000, $40,000, $50,000, $60,000 hit, rather than coming into a house and being, upside down with a payment that you thought a payment that you can't really afford. So a lot of people are just going to be backing out, and then the houses are going to be repriced.
Yeah, but here's the interesting thing. So the underlying asset, the house, is actually significantly appreciated in value, but because of what's happened with interest rates increasing and the stock market and crypto decreasing, those people might not be liquid enough to actually get a mortgage anymore. So
Yeah, that's true
they're
too.
actually going to potentially lose their down payment on an asset, which is significantly more valuable than what they actually purchased at that time, like 2 years ago.
Or you just
So
created a new business model for yourself to go out and make people liquid and take part of their
yeah,
property.
exactly, and then profit from the purchase price
Yeah,
relative to the market value.
to become an
Yeah,
equity owner by
yeah,
helping them become liquid, even though it really doesn't cost you anything because they just pay you back. Or if they
yeah.
don't pay you back, you get the house.
Get the house at the higher market price. People who were like former hedge fund managers who, kind of use that as like a badge of honor.
Yeah.
What,
So
what do you think about that?
if you're an ex hedge fund manager, that means you used to be a hedge fund manager, which probably means you failed as a hedge fund manager, because if you weren't failing as a hedge fund manager, you still would be a hedge fund manager. So ex hedge fund manager to me doesn't bring out that credibility that people think, or that I think it should. I think it's a non-credible thing, because it showed that you failed, and not only that you failed, but you didn't start over again. Like you didn't have any kind of edge.
Yeah, you gave up.
You gave up because,
Right.
what's interesting, I
work.
was watching CNBC the other day, and the guy was talking about how, here's what the hedge fund managers do. They'll take a 50% drawdown. If they're getting their butts kicked, they take a 50% drawdown, right? And then what they do is they just close the whole thing and start over. And so they lose 60-70% of their investors, but 30% come back in, and they have a new high water mark. See, because
to reset it so that way they can collect fees, right?
there you go. Because you can't collect
Yeah.
fees if I'm 50% down. Now I got to go up
Right.
100%. Then I can start collecting fees.
Uh-huh.
Whoa, that's going to take 4 years or 7
So then
years. I'm out of
only
here.
getting like the 1.5-2% management fee, and from that perspective, it's not worth it for them. So they might as well just reset.
Exactly. And that's what they're doing. They're resetting, which is
It's
kind of
like a company that goes out of business, takes out a lot of loans, and then declares bankruptcy, and then just opens up like the next day under a different name, another LLC.
Yeah, exactly. Now your audio just kind of got weird. Do you hear me okay?
Yeah, I can hear you.
But your audio just kind of went to echo mode for some reason. I don't know why.
All right, well, we're pretty much wrapping up anyway. Yeah, so thank you so much. Are there any other so I'm gonna put the links to your channel and everything
Okay.
down in the description.
Description? Yeah. And I'll put a links to your channel and stuff when I show this on my channel too.
But let's just say it anyway, so that way it shows up in the video. So when the algorithm, when they go through like the transcript of it. So my channel is Best Stock Strategy, and my website is beststockstrategy.com. And Carl, can you
my channel is called Real P&L because I show my real P&L. So I hope that's easy to remember.
Awesome. Well, thank you guys. If you have any questions for me, then leave a comment below. You can also check out Carl on the Real P&L channel. And we really hope that you enjoyed this. And again, if you have any questions for us, then we're here for you. Thank you so much.
Thanks. I hope people got value out of it. Thanks, David. I appreciate it.